Yeah, imagine this, a marketplace, right? But one where billions, literally billions of euros are changing hands every single day. It connects local businesses, maybe even ones, to huge global investors, facilitates everything from, I don't know, a small startup IPO to massive corporate bonds. And it's doing all this while navigating these huge geopolitical shifts like Brexit.
Yeah.
It almost sounds like something out of a financial thriller, doesn't it? But it's real. It's the incredibly complex and really strategically vital world of Euronext. So today, we're doing a deep dive. It's Euronext N.V, ticker ENX.PA. And this company is basically the central nervous system, for capital markets across, 7 major European economies. And when we say deep dive, well, we really mean it. We've gone through a mountain of material for this one. Everything from detailed investment research analysis on Euronext, their latest financials, industry insights, just tons of stuff. And our mission, well, it's pretty much the same as always. We want to pull out the really key bits of knowledge for you. Give you that shortcut,
So understanding this really critical bit of infrastructure, stuff that often goes unseen. When we look at how Euronext built such a resilient business, what really makes it tick? And this fascinating mix of tech, regulation, market dynamics, it's all in there. You might think of the stock exchange as, just a place stocks are traded, a platform. But what if it's actually evolved into something much more complex, something strategically vital?
It really has. And what's so fascinating here, I think, is how Euronext really shows the evolution of market infrastructure itself. It's not just about being a venue anymore. We're seeing this shift, right? Moving beyond just transaction platforms to becoming these integrated service providers. They underpin the whole financial ecosystem. And the source material, it really highlights this interesting blend. You've got the local traditions, each market keeping its identity labor, but then you've got this layer of pan-European innovation, the technology tying it all together. It's a really powerful mix, tells us a lot about where finance might be heading.
Okay, so let's unpack that. This pan-European federation model Euronext uses, it's not just one exchange, like you said. It's much bigger. It's this huge network, right? Regulated markets for securities, derivatives across Belgium, France, Ireland, Italy, the Netherlands, Norway, and Portugal. I mean, that's a massive footprint across Europe.
Yeah.
Really diverse.
It absolutely is. And that spread geographically and regulatorily, it's fundamental. It's core to their strength. This model, it does a great job connecting those local economies to the big global capital markets. And each national exchange in the federation, think of the Paris Bourse, Milan, Amsterdam, they keep their local brand. That's not just marketing fluff. It's crucial. It preserves that deep trust, those long-standing relationships, the cultural links they've built over, decades. With the companies listing there, the local investors, everyone, those relationships are gold. But, and here's where it gets really clever, technologically speaking, all these separate seeming local markets, they're unified under one single advanced tech platform, Optique. And they operate with a harmonized rulebook. So it's not just a loose collection. It's a deeply integrated high-performance system.
Right, Optique, we'll come back to that. And this integration, the analysis points out, it creates basically the largest, deepest single liquidity pool for cash equities in Europe. Okay, so for our listeners, can you break that down? What's the practical impact? Having one massive pool versus, say, 7 separate little puddles. What does that mean for a big global trader?
Oh, the impact is huge. It really translates directly into efficiency, better execution for anyone trading. So imagine you're a big asset manager, right? And you need to buy or sell a large chunk of shares in several European companies. Instead of juggling separate systems, different rules, different tech interfaces for each country, which would be a nightmare, Euronext offers one single access point, one set of rules, mostly harmonized, one tech backbone. That dramatically cuts complexity, lowers costs for them, and crucially, it aggregates all the buy and sell orders. And when you have that deeper pool of liquidity, well, there are just more buyers and sellers around at any given price, which usually means tighter spreads the difference between buy and sell prices and less market impact when you place a big order. You don't move the price against yourself as much. It's kind of the best of both worlds, local trust, local regulation, but with pan-European scale and tech, it's a strong titch.
That federation model, it sounds incredibly solid. But thinking from a competitor's angle, how hard is it really to replicate? Is that moat truly uncrossable? Or could someone with deep pockets and, say, a lot of ambition try to chip away at it? You can't just spin this up overnight, surely.
That's a really good question because, no moat is completely unshakable forever.
Right.
Markets change. But Euronext's moat here, it is exceptionally deep. and wide. I mean, to replicate it, a competitor wouldn't just need a top-tier tech platform like Optic, which by itself is a massive multi-year, likely multi-billion euro job, but maybe even harder, they'd need to navigate the incredibly tangled regulatory, legal, political stuff across 7 different countries. They'd need to win over local regulators, build those deep relationships Euronext has spent decades on with local companies, investors, and then somehow convince everyone to shift their ingrained trading habits, their order flow. It's just a monumental task. It needs the tech, yes, but also immense political skill, commercial integration. So while, yeah, nothing's impossible, this specific structure, it's a formidable barrier. Makes it incredibly tough for a new player to really challenge them head on.
Okay, so that deep integration pays off. And we see it really clearly when we look at their dominance in European cash equities. The numbers here, they're not just good, they're kind of staggering. In 2024, Euronext processed, get this, 2.7 trillion in transaction value. Trillion. That's more than double the combined total of LSEG and Deutsche Börse, their closest rivals. They were around 1.05, 1.06 trillion each. That's not just leading, it's commanding. Almost overwhelming.
Absolutely commanding. And it's driven by this principle, this core idea called liquidity gravity. Think of it like this. Market participants, big institutions, hedge funds, even those super fast algorithmic traders, they naturally gravitate towards the places with the deepest order books, the tightest spreads.
Because they get better prices, better execution.
Yeah, exactly. If you need to buy or sell a lot of stock, you want to do it smoothly without causing ripples and at the best possible price. So Euronext, by pulling all that order flow from its different markets onto one platform, has created this massive gravitational pull. As its liquidity grows, it pulls in even more orders. It's a self-reinforcing cycle, a powerful one. It just becomes the default place to trade European cash equities because everyone else is already there, which reinforces its position. It's a classic network effect, really, just on a huge scale.
Yeah, I can definitely see how that liquidity gravity creates that network effect. It's powerful. But in today's world where everything seems disruptible, are there any weaknesses to that gravity? Has anyone challenged something like this effectively in other markets? Or is it just an unshakable advantage for Euronext in Europe?
It's a fair point. Challenging deep liquidity is tough, but not impossible. Usually challenges come from, say, regulators trying to force more competition, which can fragment things, or from some genuinely new tech that changes how people trade. We've seen it elsewhere, like in the US, where alternative venues, dark pools and the like, have grabbed quite a bit of market share over time, even from the big exchanges. But for the main, transparent, listed market, that central limit order book, the kind Euronext provides, it's still really the gold standard for finding the true price. Competitors might nibble at the edges, maybe offer cheaper execution for big hidden trades, but displacing that core price discovery function is hard. And Euronext's model, the Federation plus the Optic tech, gives them a pretty strong defense, makes that liquidity gravity very, very sticky.
Okay, so they've really mastered building these deep pools of liquidity. But the Euronext story isn't static, right? It's about constant evolution. The analysis really stresses the strategic shift, moving from just being a place where trades happen to becoming a true full-service market infrastructure provider. Brie, can you unpack that? What does full service really mean in practice, and why is that shift so important for them?
Yeah, that shift is absolutely critical. It moves them into a much broader and ultimately more profitable space. Traditionally, an exchange might, just provide the trading screen essentially, but full service market infrastructure, that means controlling more of the whole transaction chain. So not just the trade itself, but everything that happens after the trade clicks. The clearing and making sure both sides honor the deal, the settlement, the actual swap of shares for cash, and even the custody holding those securities safely. This vertical integration, controlling more steps, lets them capture more revenue from each transaction. And crucially, it makes them less reliant on outside companies for these vital services. We'll definitely get into this more when we talk Borsa Italiana, because that acquisition was the key move in making this full-service vision a reality. It brought clearing and settlement right inside. It's a strategic move towards having more control, more autonomy, and tapping into higher margin services.
Okay, let's switch gears and look at the money. The revenue machine behind Euronext, because how they make money is really insightful. In 2024, total revenue was $1,626.9 million. That's up a healthy 10.3% from the year before. But the breakdown, where that money comes from, that shows a really diverse, strategically built engine. So first, trading. Still the biggest slice, right? 34.4% of revenue, about $559.4 million. Within that, cash trading, their traditional bread and butter, brought in $284 million. But the thing that really jumped out at me in the reports was fixed income trading. it shot up. An amazing 35.5% growth, hitting 145.5 million. What drove that huge surge in fixed income? And what does it tell us about how adaptable Euronext is? And of course, there's other stuff in trading too, derivatives, FX, power. They all chip in.
Yeah, that fixed income surge is a fantastic example of how they can really capitalize on big macro trends. The source material points right at the aggressive interest rate hikes by central banks in 23 and 24.
Oh, okay.
Volatility.
Yeah.
Exactly. As rates shot up, it created huge uncertainty, loads of volatility in bond markets. And that spurred a massive increase in trading and hedging activity, fixed income, related derivatives, investors, companies. They all needed to manage their interest rate risk urgently. And Euronext platforms, especially MTS, which they got with Borsa di Italiana, were perfectly set up to handle that flood of activity. It really shows how their diverse asset classes and those strategic buys let them capture market action, even if, say, equity trading is quieter. Okay, so moving on to a real pillar of their stability. Post-trade services. This was a big chunk, 25.5% of revenue, 414.7 million. And this is where you really see that recurring revenue strategy paying off. Custody and settlement, that was 270.5 million. And it's highly predictable stuff. Its revenue is tied to the value of assets they hold in custody, in their CSDs and settlement volumes, so it's much less affected by daily market swings. Very stable. Then there's clearing. That grew a strong 19.0% up to 144.3 million. And that growth, it's a direct result of bringing clearing in-house with Euronext Clearing. By internalizing that critical function, they're not just growing revenue, they're keeping a bigger slice of the pie from each trade and gaining huge strategic control over a vital piece of the puzzle.
Okay, then listing. That's 14.3%, 231.9 million. And it showed pretty impressive resilience, right? 5.1% growth, even though the global IPO market was pretty tough. That tells you something about the power of those recurring fees from their, nearly 1,900 listed companies, and the growth they're seeing in corporate services too. But for me, even more compelling is advanced data services. 14.9% of revenue, 241.7 million, growing at a solid 7.5%.
Yeah.
There's a high margin, subscription-based. I mean, this sounds like the golden goose for an exchange, right?
Oh, absolutely. Advanced data services is definitely a golden goose, and Euronext is milking it effectively. It's high margin because, think about it, the raw data, every trade, every quote, every price tick, it's generated anyway by their main business. It's a byproduct.
And they already have it.
Exactly. So packaging that up, selling real-time data feeds, historical data, fancy analytics, index licenses, it's incredibly capital efficient. Once the infrastructure's there, selling more data doesn't cost much extra. So it generates highly recurring, predictable revenue streams. Very attractive. And finally, technology solutions and other, that's 6.5%, euro 6.2 million. This just underlines the strength of their tech. They're not just using Optic internally, they're selling it, plus connectivity services, to other market players, which shows it's robust and has market appeal.
Okay, so we've mapped out the revenue streams. Diverse, increasingly stable. Now, let's unpack this core strategic pillar. Shifting away from volatile transaction fees towards more stable, recurring income. Numbers show this clearly. Non-volume related revenue, that's listing, data, custody, and settlement, tech solutions, it accounted for 58% of total revenue in 2024.
Yeah, 58%. That's a huge chunk.
So let's get into this. This is where it gets really interesting, I think. Non-volume related revenue covered a remarkable 153% of their underlying operating expenses in 2024. That's up from 145% the year before. So their predictable operations, their subscriptions, their listing fees, they generate more than enough cash to cover all their fixed costs before any trading even happens.
153%, yes. That figure, that 58% from non-volume sources and the 153% coverage. It's arguably the single most powerful indicator of Euronext's resilience and that profit floor you mentioned. It really is their superpower. I mean, think about it. If there's a massive market crash, trading volumes collapse, other financial firms might be in deep trouble, right? Layoffs, losses. But Euronext, their core operations, listings, data subs, clearing, settlement, they're already paid for by that predictable revenue. They're already in the black.
So they're essentially profitable just from the stable stuff before the more volatile trading kicks in.
Pretty much. It's like having your entire household budget covered by reliable side hustles before your main paycheck even lands. Anything extra is pure upside. The structure, it fundamentally de-risks the business model. It establishes this incredibly secure profit floor. So any volatile trading revenue, which as we saw with fixed income, can surge dramatically sometimes, that then contributes almost entirely to profit. Boosts the bottom line significantly. It gives them stability in bad times and massive upside potential in good times. It's just a testament to how well their diversification strategy has worked. A truly resilient, high-margin model. Many companies would kill for that setup.
Now, I did notice the 58% figure for non-volume revenue was actually down slightly from 60% in 2023. Is that a worry? Does it mean the recurring side is weakening?
Ah, that's a sharp observation. But it's crucial to look behind the percentage. That slight dip from 60% to 58% is not a sign of weakness in recurring revenues. Not at all. In fact, those segments, data, listing, post-trade, they still grew healthily in absolute euro terms, mid to high single digits. The reason the percentage dipped was simply because the volume-related trading businesses had an exceptionally strong year, especially fixed income, which, like you said, grew over 35%.
Ah, okay, so the denominator grew faster.
Exactly. The trading side grew so fast it made the recurring side look like a smaller percentage, even though it's still growing nicely itself. It actually shows powerful operating leverage. When trading conditions are hot, their profits surge. It's a sign of a robust business firing on all cylinders, capturing opportunities across different market conditions. Not a sign of weakness anywhere. They grew both sides, just one grew faster in 24, #check 3. Navigating the competitive arena and regulatory currents.
Okay, let's look at the neighborhood Euronext lives in, the European financial market infrastructure. It's often called a three-horse race, isn't it? The big players. Euronext, London Stock Exchange Group, LSEG, and Deutsche Börse. They all compete, but their strengths are different. We've established Euronext's clear lead in lit cash equities at $2.7 trillion versus about $1 trillion each for the others. But what about beyond equities? Where do the others have their strongholds?
It is fascinating how they've carved out different niches, leading to this multi-front competition. So while Euronext rules cash equities, Deutsche Börse is the clear leader in derivatives through its Eurex exchange. That's one of the world's biggest derivatives markets. They're also strong in clearing and data. LSEG, on the other hand, especially after buying Refinitiv, that was a game changer. They've really pivoted hard towards being a financial data and analytics giant. They're competing more directly now with the likes of Bloomberg or FactSet for that information services money.
So it's not just exchange versus exchange anymore.
Not at all. The battle is across the whole value chain: trading, data, clearing, post-trade, everything. And Euronext's own moves, especially in post-trade and data, are direct responses to this broader fight. They're trying to extend their leadership beyond just their traditional strength in cash equities.
Right. Now let's talk regulation. Always a big factor. MiFID II Markets and Financial Instruments Directive 2 came in 2018.
Yep.
Big piece of EU law. The stated goal was more competition, more transparency in financial markets. And it famously got rid of the concentration rule, which kind of forced trades onto the main exchange. It opened the door wider for alternatives and TS dark pools to compete for business.
Yeah, MiFID II definitely had a huge impact. And like you said, it was a double-edged sword. From a bearish view for exchanges like Euronext, it absolutely fragmented trading. Removing that concentration rule meant orders didn't have to go to the main market anymore. Alternative venues could compete directly, often on price, or offering different ways to trade, like those anonymous dark pools for big block trades. So yeah, that put pressure on pricing for the incumbents, spread liquidity around a bit more, and this is the bullish angle. MiFID II also came with incredibly strict rules: transparency requirements, real-time reporting, proving best execution, rules for algorithms. It massively increased the tech and compliance costs of running any kind of trading venue.
So raise the barrier to entry.
Precisely. It created a huge barrier for smaller players. It actually favored the big, well-capitalized, sophisticated operators like Euronext who could afford to meet all these demanding new rules. Plus, kind of unintentionally, it created new ways to make money from data. The unbundling of research payments meant firms started paying explicitly for data, which helped the exchanges. So yeah, it created challenges, definitely. But it also reinforced the strengths of the established players who could handle the complexity.
You really see how regulations can have these complex, sometimes contradictory effects, creates hurdles, but also entrenches the strong. It's like market Darwinism. Okay, now for a really fascinating result from a huge political event: Brexit. The analysis suggests this was actually an unexpected structural tailwind for Euronext, particularly Amsterdam. How did a political decision like Brexit end up giving Euronext such a boost?
It raises this fundamental question, doesn't it? How much can politics reshape financial plumbing? And the answer is profoundly. After Brexit, UK exchanges, mainly London, lost their passporting rights for EU clients. Simple as that. And without a mutual agreement from the EU saying UK venues were equivalent for trading EU shares, well, that trading activity just had to move. It shifted massively and abruptly from London to venues inside the EU.
And Amsterdam was right there ready.
Exactly. Euronext Amsterdam became the primary beneficiary. It basically took over from London as the main place to trade European equities. And this wasn't just a temporary blip, it was a fundamental realignment. Likely irreversible, it directly boosted Euronext's market share in a huge segment.
Yeah.
They didn't cause Brexit, obviously, but their pan-European setup and the solid platform meant they were perfectly placed to capitalize when the shift happened. It really shows how dynamic this infrastructure world is.
Wow. Okay, so beyond market share, beyond a regulation, there's also the technology, Euronext's proprietary trading platform, Optic. What makes this platform more than just software? Why is it such a key asset, a competitive edge?
Optic isn't just software, it's really the technological heart of their whole federated model. Its importance is huge. Just think about the achievement, migrating all 7 national markets, including the really complex, diverse Italian market from Borsa Italiana onto this one single platform. That is a massive feat of engineering and project management.
And the benefits?
Yeah.
Huge operational efficiencies. It dramatically cuts complexity compared to running, say, 7 different legacy systems. And it gives traders a consistent, seamless, high-speed experience no matter which Euronext market they're accessing. Think about innovation, too. Instead of tweaking 7 systems, they develop a new feature once for Optic, and boom, it rolls out everywhere. That means faster innovation, more agility in responding to what the market wants, and a more secure foundation for future growth. While some competitors might still be wrestling with integrating old systems from past mergers, Euronext's unified Optic platform gives them a real edge. Cost, speed, reliability. It ticks all the boxes.
Let's look at the numbers again, because the financial trajectory from 2019 to 2024 really tells a story of powerful growth. The top line, revenue, has just climbed and climbed. It compounded at, 19.1% per year. Went from about $679 million in 2019 to over $1.6 billion in 2024. That's not just growing, that's almost tripling revenue in 5 years. Phenomenal expansion.
And what's really telling, I think, is that adjusted EBITDA grew even faster, a remarkable 20.3% compound annual growth rate. It reached over €1 billion, 1,006.4 million in 2024. This fact that EBITDA grew faster than revenue, that points straight to significant operating leverage. It's a classic feature of the exchange business.
Meaning once costs are covered, extra revenue drops to the bottom line.
Exactly. Once that core infrastructure is paid for, a big chunk of any extra revenue becomes profit. And their adjusted EBITDA margin stayed incredibly strong, actually expanded to 61.9% in 2024, maintaining that kind of profitability even while doing the massive, complex Borsa Italiana integration. That shows exceptional cost control and really successful synergy capture from the deals. Highly efficient operation. In fact, they beat their own targets from their Growth for Impact 2024 plan for both revenue and EBITDA growth. Shows they consistently deliver, maybe even over-deliver.
So an exchange isn't like a car maker needing new factories or a retailer needing new stores all the time. How does this asset-light business model help them generate so much cash? What does that mean for their financial health?
Yeah, that asset-light nature is one of the most attractive things about this industry. It has a massive impact on cash flow. Unlike those capital-heavy businesses, Euronext's main assets are intangible, right? Intellectual property, their tech platform, brand trust, regulatory licenses. Once Optic is built or their clearing system is running, handling more trades, listing more companies, selling more data, it doesn't cost that much extra. They don't have warehouses full of stock or huge physical plants needing constant expensive upgrades.
So less money tied up in CapEx.
Much less. So their earnings aren't constantly being reinvested back into heady assets, which leads to exceptionally high conversion of earnings into actual cash. I think the figure was 90.9% of EBITDA turned into net operating cash flow in 2023. And this strong, steady cash generation, that's what lets them pay down debt quickly, invest in new organic growth ideas, and consistently pay dividends. It gives them huge financial flexibility and resilience. It's a fantastic setup.
And speaking of paying down debt, deleveraging. That's another really impressive point. After buying Borsa Italiana, which was huge, their leverage peaked at 3.2 times net debt to adjusted EBITDA. Seems reasonable after a big deal. But by the end of 2024, it was down to just 1.4 times. Very conservative, well inside their target range. That's incredibly fast deleveraging. Shows real financial strength, doesn't it?
It absolutely does. Dropping leverage that quickly in just over 3 years after such a massive acquisition, it just highlights the incredible cash generation power we were just talking about. It shows disciplined financial management and really robust cash flows. And the market noticed. This financial discipline led to a credit rating upgrade from S&P. They bumped them up to A stable outlook in early 2025. And that's not just a nice headline. An upgrade like that usually means it's cheaper for them to borrow money in the future, gives them even more flexibility for strategy. And it signals to everyone, investors, clients, regulators, that Euronext is financially solid and stable. It's strong validation of their strategy and how well they executed it.
Okay, let's dive into that company-making acquisition,
Yeah.
Borsa Italiana. They bought it in 2021. How did this deal fundamentally reshape Euronext? Why was it so much more than just adding Italy to the map? What made it truly transformative?
Transformative is definitely the right word. It wasn't just another bolt-on. It was a hugely complex integration, took multiple years, but they wrapped it up successfully in September 2024, with the final bit being the migration of Italian derivatives clearing. Operationally, big steps included moving Euronext's main data center to Italy, consolidating all the Italian markets onto Optic. It was a massive project. And financially, it blew the initial synergy targets out of the water. They're on track for $115 million in annual EBITDA synergies by the end of 2024. That's almost double the $60 million they first aimed for. Shows superb execution on the integration.
But the real strategic game changer wasn't just the cost savings, right? I understand it gave Euronext two absolutely critical pieces they were missing: a multi-asset clearinghouse, Euronext Clearing, and a big central securities depository, a CSD. How crucial were those additions for their bigger strategic picture?
That's exactly it. That's the heart of the transformation, vertical integration. Before Borsa Italiana, Euronext relied on third parties for a lot of critical post-trade stuff: clearing, settlement. Now, with Euronext Clearing and the big Italian CSD, they control the whole chain, end to end, from listing a company to trading its shares, all the way through clearing the trade, settling it, and holding the securities.
Capturing more value at each step.
Right. They keep more of the revenue from each transaction instead of paying fees out to partners. But maybe even more importantly, it gives them huge strategic autonomy, control. They've drastically cut their dependence on outside providers, especially LCH.SA, which is mostly owned by their competitor, LSEG.
Ah, interesting dynamic there.
Very. So having their own critical infrastructure, it boosts their resilience, lets them develop new integrated products much more easily. It's a massive long-term competitive advantage. Few others in Europe have that kind of control across so many markets. It makes them truly self-sufficient.
Okay, so Borsa Italiana integration done and dusted, exceeding expectations, and Euronext immediately pivots, unveils new strategic plan, Innovate for Growth 2027, which signals a shift, doesn't it? From huge M&A like Borsa towards pushing organic growth faster. Interesting timing. What are the key pillars of this next chapter for them?
It is interesting, isn't it? Finish one huge thing, immediately launch the next ambitious plan, shows focus. And Innovate for Growth 2027 is definitely ambitious. They're targeting over 5% compound annual growth CAGR for both revenue and adjusted EBITDA from 2023 through 2027. And this growth, it's built on three main interconnected pillars. First, keep accelerating growth in those non-volume businesses we like: data, corporate services, the high-margin, predictable stuff. Second, really expand their fixed income, currencies, and commodities franchise, FICC. Leverage those new clearing capabilities they got from Italy to offer more integrated FICC products. And third, build on their leadership in trading cash equity ETFs. Keep innovating there, add new features, expand products. It's a plan focused on sustainable growth, higher margins, really leveraging the bigger, stronger platform they now have.
So for you listening, it shows this isn't a company sitting back after a big win. They're already strategically planning how to get the most out of their enhanced setup for the next few years, thinking long-term. Okay, finally on strategy, let's touch on capital allocation, how they use their money. They balance growth investment with shareholder returns, right? They have this clear 50% dividend payout policy on reported net income, proposed £2.90 per share for 2024. What does that policy tell us about how they think financially?
That capital allocation strategy is pretty key. It shows discipline, but also flexibility. The 50% payout gives shareholders a consistent, decent return. That's attractive. But it also means they retain half their earnings. And that retained capital is crucial. It funds those organic growth ideas in the Innovate for Growth plan, and it helps them keep a strong balance sheet. They target leverage between 1.0 and 2.0 times net debt to adjusted EBITDA. That leaves plenty of headroom. Gives them the flexibility for maybe smaller bolt-on acquisitions in the future if the right opportunity comes along, without overstretching themselves. And they've shown they'll do share buybacks too when it makes sense, like that $200 million one after they sold their stake in LCH.SA. So it's a balanced, dynamic approach to managing capital. #TagTax6. Recent dynamics and critical risks.
Let's talk about some recent dynamics that have really affected Euronext, like the interest rate cycle. Central banks hiking rates aggressively in 23, 24 actually created some big tailwinds for Euronext, didn't it? How exactly did rising rates turn into a positive for an exchange?
Yeah, that period of sharp rate hikes really boosted activity, especially in fixed income and derivatives, a direct tailwind. The data shows interest rate derivatives trading in the EU jumped, what was it, 29% CAGR from 2022 to 2024. Huge growth.
Why? Just more hedging.
Exactly. As rates moved fast, companies, investors, they all scrambled to hedge their interest rate risk, adjust portfolios. That meant way more trading volume, which directly boosted Euronext's fixed income revenue up that huge 35.5% in 2024. Plus, a side benefit, higher rates meant Euronext Clearing could earn more interest on the cash collateral it holds, so net treasury income went up too. The risk, of course, is that it's cyclical. If rates stabilize or volatility drops, that exceptional growth might moderate. Although, interestingly, the reports note that even when the ECB started small cuts, those derivative volumes stayed pretty high. Suggests maybe ongoing uncertainty, not just rising rates, keeps people hedging.
Okay, another ongoing challenge, kind of cemented by Mestetsai, is competition from alternative trading venues, ATSs. We mentioned dark pools for anonymous block trades, but they're also systematic internalizers. Can you quickly explain what those are, and how do these different alternative venues put pressure on exchanges like Euronext?
Right. Systematic internalizers, or SIs, they're usually big investment banks. And what they do is execute client orders directly against the bank's own capital. They basically become the market for that trade, bypassing the public exchange. They act as principal, provide the liquidity themselves, often without showing prices publicly beforehand. So these SIs, along with dark pools and MTFs, were really enabled or boosted by rules like MiFID II. They offer users things like maybe lower fees, more anonymity for big trades, maybe faster execution sometimes, and that directly competes with the exchanges. It fragments the order flow, takes volume away from the central market. We see it starkly in the US, right, where nearly half of all equity trading happens off exchange now.
So how does Euronext defend against that fragmentation?
Well, they focus on their core strengths, and they adapt. Their main defense is the unbeatable depth and transparency of their main market, the central limit order book. That's still the best place for discovering the real price. And the closing auction, that end-of-day mechanism to set the official closing price. That's absolutely critical for funds index trackers. They need that official price. Plus, Euronext isn't standing still. They offer their own non-displayed trading options now for clients who want to trade big blocks without moving the market. The fact that they've kept such a dominant market share in lit European trading shows they've navigated this pretty well so far. The core value of the main exchange is still strong, even with these alternatives nibbling away.
And then there's the hangover from COVID, right? The pandemic brought crazy volatility, record trading volumes. Now things are normalizing, which must make year-on-year comparisons look tough for trading revenues.
Exactly, and this is where that diversification strategy really proves its worth again. It's a perfect example. Cash trading revenue, for instance, yeah, it did dip in 2023 compared to the peak levels of 2022. Volatility just came down, but Euronext's total revenue and profit, they still grew in 2023. Why? Because the weakness in cash trading was offset by that strength in fixed income we talked about, driven by rates, and by the steady, solid growth in the non-volume businesses, data, listing, post-trade. It just highlights how the diversification smooths things out, makes the overall business much less vulnerable to swings in one particular market segment, a really robust model.
Okay, but no business is risk-free. Euronext runs critical infrastructure, highly regulated, dynamic world. What are the key risks they have to constantly manage? It must be a complex web.
Oh, absolutely. And their reports lay these out pretty clearly. They face risks across several big categories. First, strategic risks. Just managing huge, complex projects like the Borsa integration, while also launching the ambitious Innovate for Growth plan, that's inherently risky. Execution risk. Plus, the intense competition we discussed across all business lines from multiple angles. That's a constant strategic pressure. Then, regulatory risks. Being so heavily regulated means they're always exposed to changes in financial laws, new MiFID rules, other directives. These could really impact their business model, their profits, and managing compliance across 7 different countries adds complexity.
Right. What about operational stuff? Day-to-day running. Big ones there. Operational risks. As critical infrastructure, cybersecurity is absolutely paramount. They're a prime target for sophisticated attacks. A breach would be devastating. Technology failure is another big one. System outages. If Optic or Euronext Clearing goes down, that could halt trading across Europe. Huge reputational and financial damage. And they still rely on some third-party service providers for certain things, which introduces another layer of operational risk. And finally, market and financial risks. Despite diversification, trading volumes are still cyclical to some extent. That remains a factor. And currency risk, too. They operate in Norway, Denmark, non-euro countries. Fluctuations in the krone can affect their reported results when translated back to euros. So yeah, it's a complex landscape of risks they need to constantly monitor and manage with strong controls and resilience planning. Let's talk valuation. How does the market value Euronext compared to its peers? We're looking at LSEG, Deutsche Börse, maybe the U.S. giants like ICE and CME Group. What do the multiples tell us?
Okay, looking at the numbers around Q3 2025, Euronext trades at a bit of a discount to its European peers on a price-to-earnings basis. Its trailing PE was around 22.3x. LSEG was higher at 26.1x, Deutsche Börse at 23.8x. On an EV to EBITDA basis, it's closer, Euronext at 17.1x, LSEG higher at 21.0x, but Deutsche Börse actually a bit lower at 16.5x. So mixed there. But the discount gets much bigger when you compare them to the big US exchanges. ICE was trading at a PE of 38x. CME Group at 26.5x. So clearly, investors see things differently across regions and specific business models.
That's quite a range in those multiples, especially the U.S. ones being so high. Why the big differences? Is it just market size or something more fundamental about their businesses?
It's likely a few fundamental things driving that. Business mix is probably a big one. The U.S. exchanges often have a much larger slice of their business coming from very high-margin derivatives trading. That often gets a premium valuation because of its growth and profitability. Could also be about perceived growth prospects. Maybe investors just expect faster growth from certain players or regions. LSEG's premium, for example, might be tied to that successful shift towards data and analytics after buying Refinitiv. Investors might see it more like a high-growth data company now, less like a traditional exchange. So each exchange has its own story, its own mix of assets, its own growth path. Euronext's current valuation seems to reflect its strong but perhaps more traditional, diversified pan-European exchange model. Solid, but maybe not perceived as having the explosive growth potential of some others. And looking at Euronext's own history gives us more context too, helps understand the current mood. That current PE of 22.3x, it's towards the top end of its range over the last 5 or 6 years, which was roughly 16x to 23x. Similarly, the EV/EBITDA multiple of 17.1x is in the upper half of its recent range, which was about 12x to 19x. So while it's not at absolute peak valuation, the market is definitely pricing it more optimistically now than it has at times in the recent past.
Which suggests the market is buying into the success story, right? Pricing in the Borsa integration being done well and believing in the Innovate for Growth 2027 plan. Seems like positive sentiment. But stepping back a bit, why do exchanges in general often trade at premium valuations compared to, say, the average company? What are those core characteristics that make investors pay up for these businesses?
That's a really key question. It gets to why these financial infrastructure businesses are seen as premium assets. They benefit from this really compelling cocktail of durable business strengths. First, like we discussed, incredibly high barriers to entry. You need the regulatory licenses, massive tech spend like Optic, and that sticky liquidity gravity, hard to replicate. Second, high operating leverage. Once the fixed costs are covered, extra revenue flows strongly to profit. Great margins as volumes grow. Third, that asset-light model we talked about means fantastic cash flow conversion. They generate a lot of cash relative to earnings. And finally, as the main place for listing stocks and finding prices, they often have real pricing power in their core markets.
Those are definitely the qualities investors love. Creates those lasting competitive advantages.
Makes total sense. Okay, last point of valuation, the dividend. They have that clear 50% payout policy. Consistent dividend. 2.9 euros per share proposed for 2024. How does that dividend fit into the overall investment case for Euronext?
That consistent dividend policy is a really significant part of the appeal, especially for investors focused on income. If you compare Euronext's yield to other stable income-paying sectors in Europe, maybe utilities or infrastructure assets, it can look quite attractive. It offers this blend, a reliable, growing income stream linked to their strong financials, combined with exposure to the growth dynamics of European capital markets. So it's potentially an interesting option for someone wanting both steady income and some potential for capital growth. A nice combination. #tech outro.
Okay, so we have really taken a deep dive into Euronext today. We've looked at that unique federated model across 7 countries, their smart strategic shift towards more stable, recurring revenue streams, their dominance in cash equities, helped along by things like Brexit, and the huge success story of integrating Borsa Italiana. We see the impressive financial growth, the smart use of capital, the ambitious plans for the next few years, all while navigating this really complex world of competition and regulation.
Yeah, and if you zoom out, connect it to the bigger picture, Euronext is much more than just a stock exchange. It really exemplifies how critical financial infrastructure is evolving, becoming more diverse, more technologically sophisticated, more strategically independent. And it raises this interesting question, doesn't it? In this global financial world that seems increasingly fragmented in some ways, but also connected, how much more powerful would these vertically integrated market operators become? The ones that control the whole process end to end with strong local roots, but also that pan-regional scale. It's something to watch.
Absolutely. So the next time you hear about market action in Paris or Milan or Amsterdam, you'll have a much deeper sense of the complex, powerful engine running underneath it all. What aspect of your own strategy or evolution stood out most to why you listening in? Maybe dig a little deeper yourself. Explore how that Innovate for Growth 2027 plan might impact specific markets you're interested in. But for now, thank you for joining us on this deep dive into the heart of Europe's capital markets.